Good morning. It's Monday morning, April 15th, the dreaded tax day. It's 7:30 Mountain Time. This is the free audio summary of our weekly note, which was titled Macro Regime Change. And the real theme of the note was to underscore just how this environment differs in so many ways from the 1990s. It was far more similar to the 60s. Now, the reason to even discuss the 60s or 90s is both were very strong capital investment environments with strong equity market returns as well. The key difference, though, was in the 90s that we were in the second decade of a long, 4-decade disinflationary environment that led to a 39-year or contributed to a 39-year bond bull market, whereas in the 60s, we were in the second decade of a reflationary environment and bond bear market. And that's at the core of what we really dug into in the note this week. All that was on offer last week as we had a hot CPI, a 10-year note auction that tailed 3 basis points. We had a budget deficit that came in at 1.06 trillion for the first 6 months, almost the same level as what we had for the first 6 months of the prior year. Again, this is a big part of the story. So as we got into the inflation numbers this week, we tried to differentiate a little bit from all the bottoms up stuff we saw in response to CPI from the broader top down themes. So there's 2 papers that we referenced at the beginning of the report: A Fiscal Accounting of COVID Inflation and 3 World Wars, Fiscal and Monetary Consequences, both which were similar papers that discussed the role that fiscal policy played in increasing aggregate demand and leading to this inflation. Now, part of our aversion to all this, picking apart the inflation numbers from the bottoms up, and we did some of that in the report to be sure, is that, and we'll use the ex-shelter measure as an example. A year ago, we were looking at ex-shelter, but the reason we were looking at ex-shelter CPI or PCED a year ago is because all the other major components, non-housing services, core goods, energy, food, they were all falling at that time. And it was widely expected that housing related inflation would fall as well because we'd seen current measures of rents that were headed down. Well, here we are a year later, and we've got the chart, if you look at this on a video, of rent of or core housing, core services ex housing inflation, super core, if you will. The momentum is strong. 3-month is over 6-month, which is over 1 year. So that's headed higher. Core goods prices look like they're bottoming. Energy prices are moving up. Food prices look like they might be heading up as well. So looking at ex-shelter inflation is cherry picking. Looking at just blaming it on auto insurance or healthcare insurance, again, it's cherry picking. We dug into how healthcare inflation is likely to go higher over time, the role of fiscal policy, and even how the Fed's comforted themselves that the risks to wages are small because we've got this big supply increase in labor from immigration, but that only hits the lowest income quartile of wages. It's not going to have much impact on the middle or upper income quartiles. And as a consequence, we still have very expansive fiscal policy, 7% budget deficits that's driving inflation higher. So this is an environment where, like the 60s, bond returns are likely to be negative, stock returns are likely to be positive. We're looking at a point in time where, we may very well get our moment like we had last fall, and stocks start reacting to the higher level of real rates. Perhaps it's 2.5% in 10-year real rates. That's roughly where we got to last October, 5% in nominal 10s. So for the interim period, we would continue to avoid small caps, small banks, any interest rate sensitive sectors, stick to industrials, energy, materials, and tech related, we'd be market weight on. We still think there's a strong story there. We need to work through earnings season, We're focused on profitability of the banks. They obviously got off to a rough start because of pressure on net interest income related to the deeply inverted curve. And but when industrials start reporting, that should be more favorable. And tech will probably work out pretty well, given the fact that the group is lagged a little bit as of late. So on balance, there's no change in our game plan. Stick to the front end of the treasury curve, avoid rate sensitive parts of the stock market, and the market will probably not, equity market will probably not react negatively to higher rates until we start approaching those October highs. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.